Hey everyone, and welcome to this explainer. Think of this as your exclusive mock exam review session, custom built to coach you straight to an A-star in IGCSE Accounting 0452. Today, we're zeroing in on high-yield accounting principles, nailing down procedural accuracy, and really tackling those complex evaluation questions. So, whether you're just trying to secure those crucial method marks or you want to absolutely crush the evaluation section, you are definitely in the right place.
Okay, let's take a quick look at our agenda for this masterclass. We'll be running through the core equation review, followed by technical execution and traps, then some AO3 ratio analysis, and finally we'll dive into some examiner secrets.
All right, kicking things off with Module 1, the core foundation.
Right out of the gate, there's a massive shift in language you absolutely have to know about. For the 2026 syllabus, Cambridge has fully flipped the switch to modern international terminology. The examiner is looking for absolute 100% precision here. You've got to use terms like irrecoverable debts instead of the old bad debts, and owner's equity needs to be spot on. Literally ditch the old vocabulary today, because using outdated terms is basically a giant neon sign telling the examiner your knowledge is out of date.
When you're under the intense pressure of a timed exam, keeping track of the duality of every single transaction can get messy. So just remember the ALE mnemonic. Assets equals liabilities plus equity. It sounds incredibly simple, right? But honestly, keeping this core equation perfectly balanced in your head while the clock is ticking, well, that's exactly what separates the top-tier students from the rest of the pack. Every single transaction has to respect that balance.
And actually, keeping things grounded in reality brilliantly illustrates the prudence concept. Picture this. You know a client is likely going under and probably won't pay their invoice. Trying to sweep that potential loss under the rug? That totally violates transparency. By ignoring it, you're just creating an overstated profit. Applying prudence means stepping up and recognizing that potential loss immediately. This ties right back into the specific vocabulary you've got to master, words like accrued, prepaid, realization, and consistency. Banks and tax authorities literally rely entirely on this kind of transparency.
Okay, moving right along to Module 2, Technical Execution and Method Marks.
So technical execution is all about being incredibly methodical. You have to actively show your procedural flow through these exact 4 steps, because examiners love and will heavily reward logical progression. It all starts with the source document, like an invoice, right? Then it moves to the books of prime entry, and then straight into the absolute gold standard of double entry, the T accounts. Oh, and here you really must master the difference between balance brought down and balance carried down before finally hitting the trial balance. Showing every bit of your working is exactly how you scrape up those vital method marks, even if your final number is a bit off.
But listen up, because even with a flawless process, mathematical traps are everywhere. We see the same pitfalls in recent past papers over and over. A huge one? Students constantly miscalculate percentages because they mix up trade discounts, which happen right at the point of sale, with cash discounts, which happen later at the point of payment. Also, please do not forget to include your state symbols in manufacturing accounts. Seriously, those are just easy, free marks that you do not want to throw away because you are rushing.
All right, let's get into the heavy-hitting stuff. Module 3, AO3 Evaluation and the Trick Question.
Okay, imagine you're sitting in the exam hall. You're looking at a notorious trick question pulled straight out of a 2024 past paper. You crunch the numbers and find that a business's current ratio has just plummeted from a really healthy 2.5 to 1 all the way down to a super risky 1.1 to 1. Now, you've done the math perfectly. Great. But that calculation, that's just baseline stuff. Because the follow-up question is going to ask you to actually evaluate the scenario. Doing the math gets you the initial marks, sure. But an A-star student looks at that drop and asks, wait, what does this actually mean for the business in the real world? Why did their liquidity just fall off a cliff? This is where you have to dig into the high-level causes behind the numbers. Maybe they weren't crazy in massively overpurchased inventory, tying up all their actual cash and stuff sitting in a warehouse. Or maybe trade payables are being paid way too slowly, which is completely wrecking their supplier relationships. Or, and this happens a lot, maybe their cash reserves were just wiped out by a massive capital expenditure, like buying a huge new piece of machinery. This is the exact analytical mindset you need to bring to the table.
Now, evaluation also means comparing different businesses, which is inherently tricky, right? Because differing internal policies can make a direct comparison super deceptive. It's like comparing apples to oranges. For instance, if firm A uses straight-line depreciation and firm B uses the reducing balance method, their asset values and profit margins are going to look entirely different on paper, even if, in the real world, they are performing exactly the same. You absolutely have to point these differences out to the examiner.
And to really maximize your AO3 points, you've got to discuss the quality of the profit by looking at non-financial factors. We're talking about things like staff morale, the physical location of the storefront, and their overall market reputation. None of these things are written in the ledgers, but they are absolutely crucial for understanding a company's true long-term return on capital employed, or ROCE. Do not leave these non-financials out of your written answers.
Which brings us to our final section, Module 4, Examiner's Secrets and Strategy.
Look at this. This is literally a massive red flag warning, straight from the principal examiner reports for 2024 and 2025. Quote, students often lose marks through poor handwriting in ledger accounts and the failure to distinguish between revenue and capital items. I mean, wow. Do not let messy handwriting tank your grade just because the grader literally cannot read your balance brought down numbers. And maybe even more importantly, you have to be able to tell the difference between revenue expenditure, like, fixing a broken window, and capital expenditure, like buying a whole new delivery van. Mixing those two up, that is a guaranteed way to bleed crucial marks.
So, as we wrap up this review session, I really want you to let these concepts sink in. Remember your ALE mnemonic? Stick strictly to the prudence concept, always double-check those tricky discount percentages, and push yourself to look past the basic math to find the real story behind the ratios. When you sit down for your very next mock exam, I want you to ask yourself, are you just acting like a human calculator, or are you actually telling the financial story that the examiner is absolutely begging to read?